is a video training module on inventory valuation by businesstraining.com. Welcome everyone. The goal of this presentation is to talk about inventory valuation methods and explain it via a numerical example. We will review 3 inventory valuation methods and also a valuation example to compare the 3 methods. 3 methods are average cost, first in, first out, last in, first out. So what is inventory? Inventory is defined as assets that are intended for sale, are in process of being produced for sale, or are to be used in producing goods. Inventory consists of raw material inventory, packing material inventory, work in process inventory, finished goods inventory, variances, depending on the inventory recording method. From another angle, beginning inventory plus net purchases minus cost of goods sold equals ending inventory. Let's see the valuation methods one by one. I'm going to start with first in, first out method. First in, first out assumes that the first unit on inventory is the first one sold. For instance, you produced 50 units on Monday, your production cost is $10 per unit. You produced 40 units on Tuesday, your production cost is $11 per unit. You sell 40 units on Wednesday. Based on first in, first out method, your cost of goods sold will be $10 per unit, as this was the cost of the first unit taken back to the factory. Important to note that cost of goods sold appears on the income statement, while ending inventory appears on the balance sheet under current assets. Last in, first out method. This method assumes that the last unit making its way into inventory is sold first. The older inventory therefore is left over at the end of the accounting period. For instance, you produce 50 units on Monday, your production cost is $10 per unit. You produce 40 units on Tuesday, your production cost is $11 per unit. You sell 40 units on Wednesday. Based on the last in, first out method, your cost of goods sold will be $11 per unit, as this was the cost of the last unit taken to inventory. It's important to know that cost of goods sold appears on the income statement, while ending inventory appears on the balance sheet under current assets. This method is quite simple. The average cost method. It uses the weighted average of all units available for sale during the accounting period, and then uses this calculated average cost to determine the value of cost of goods sold and ending inventory. This is demonstrated via the numerical example on the slide. $11.75 equals $47,000 divided by 4,000 units equals $11.75 per unit. It is important to understand how inventory valuation methods affect the financial analysis of the company. We have the inventory purchases that can be seen on the screen. We assume that 1,000 units are left for ending inventory. We have the following income statement based on the inventory purchases. Note: expenses are given in this exercise. If you want to try to solve it alone, you can download the exercise without the solution from the slide. We get the following income statement. First, we can calculate the value of the total inventory purchase, $39,000. Then, using the different valuation methods, we calculate the ending inventory value for the 1,000 units. This will be presented on the next slide. Then we can calculate cost of goods sold if we add the beginning inventory plus net purchases minus ending inventory. Now we have all data to calculate net income. So how can we calculate the ending inventory for the three different methods? First in, first out takes the first unit cost, $8 times 1,000, which is 8,000. Last in, first out takes the last unit cost, $16 times 1,000, that's 16,000. Average takes the weighted average of the four items, resulting in $11.75. Now we have all the three methods calculated. It can be seen that inventory valuation analysis can have a serious effect on the bottom line. That is why it's important to state in the notes to financial statements which inventory system was used. Remember, the choice of inventory valuation can affect valuation ratios and thus financial analysis. You can download the example with the solution from the file on the screen, seen below. So let's summarize what we have talked about. Inventory is defined as assets that are intended for sale, are in process of production for sale, or are to be used in producing goods. We reviewed three inventory valuation methods: first in, first out, last in, first out, and average cost method. First in, first out assumes the first unit taken to inventory is the first one sold. Last in, first out assumes the last unit taken to inventory is the first one sold. Average cost assumes the weighted average cost of inventory when it is sold. Thank you for your attention. If you have any questions, please contact us.